Hi there, my name's Miles Pitcher. I own Superior Lending. I'm a loan officer. We have helped thousands of first-time homebuyers get into their homes. Today, we're talking about one of the key pieces in qualifying for a mortgage, and that is determining how much home you can afford. We're going to look at this because this is probably the biggest issue we have right now in our home buying environment is the affordability issue of the homes. So let's jump into it. We'll run through a few of these. So affordability is a big deal. Really helps you narrow down to what fits on your qualification, what home price you can get, what monthly payment works. You'll hear me talk about this a few times, that there is a difference between actually what you qualify for and what you're comfortable with in your. Number one, I would have you look at your budget and say, what monthly payment can we make? And what is the limit of that comfort level? Just, at that point where it's like, yeah, we can make it, but that's the limit. That helps your loan officer tremendously know what price point you need to be in for your home buying. So what we look at is your gross monthly income. Yes, that's correct. Gross monthly income. We do not look at after tax. We also will look for monthly debts, which could be car loans, credit cards, student loans, any signature loans you have, any child support or alimony obligations that you have in there. We also look at your credit score, down payment, and then we find the right loan program that fits your scenario. And that could be an FHA, VA, USDA, conventional type of a loan. So affordability, generally, if I look at somebody's file and their 28 to 30% of their gross income is going towards their mortgage payment, they're doing good. That should be a comfortable payment for them. When we look at this, we're going to include in that mortgage payment the principal and interest, the taxes, insurance. And when I say taxes, I mean property taxes. Insurance, I mean homeowners insurance, such as fire insurance on your home. Private mortgage insurance that comes if you put less than 20% down, and then your HOA fee if applicable. So let's look at this debt to income ratio. I know that's a mortgage nerd word, but we'll explain what it is. Basically, it measures what percentage of your gross income goes to pay your new mortgage payment and the other monthly debt payments you have. Typically, lenders like seeing that under 45. There are loan programs where we can stretch that higher for qualifying. This really is what affects how much home you can qualify for. So let's look at this a little bit closer. DTI, debt to income ratio. Let me make this bigger. So here's a nice graphic that I like that shows there's a front end DTI and the back end. The front end is your new mortgage payment, which is going to include your loan, property taxes, homeowners insurance, HOA fee if applicable, and mortgage insurance. And we divide that monthly cost, right? We divide that by your monthly gross income, and that gets you your front end debt ratio. On the back, you'll see that we take that same mortgage payment number, but now we're going to add in your credit card minimum monthly payment, your minimum car payment, student loans. Student loans are interesting in that even if you don't have student loan payments, right? Let's say they're deferred right now, you're still in school or you just got out of school. We have to count a payment for those in this calculation. We total that up, we divide by gross monthly income. That gives you your back end ratio. Typically, where we run into bottlenecks or the restrictions on what people can qualify for is on the back end ratio, not the front end ratio. And so let's look at this here. Here's an example. Client has combined $10,000 a month gross monthly income. They have their new mortgage payment is going to be $3,000 a month. They have a car payment plus some student loans that totals $1,100 a month. We take that $4,400, we divide by 10,000. That gives us a 44% DTI in there. And so we'll use that in helping guide the client, what they can purchase, where their limits are. All right. So these are the things that really are factors in determining this affordability. Where are interest rates? How much down payment you're doing? Where's the credit score? And what are your monthly debts? How much are property taxes and homeowners insurance costs? Do you have mortgage insurance, and how much is that going to be? And then is there an HOA? All of these factor into that affordability. What can you do? Number one, the biggest factor in fixing your DTI or improving your affordability is to reduce down your other debts. So paying down your credit cards, huge deal. Paying off your student loans, paying off your car loans, that has a bigger effect than increasing your income. Now, increasing your income is good, like getting a side hustle or something like that. Having a bigger down payment is also a good thing, but paying down debts is the number one thing you can do. I would also include in that improving your credit score. I will mention that if you go and pick up a side hustle, another part-time job, there can be some limitations on counting that income immediately. You have to have a history of having 2 jobs or additional part-time income. Another thing we see that's very popular right now is I have clients who are purchasing a more expensive home, but it comes with a mother-in-law or accessory dwelling unit in the home so that they can rent that out to help offset their income. We generally can count that additional income in as part of your income in helping you qualify for more home. So this is a big important thing, is to get pre-approved early. The reason why this is so important is that there are, depending on the loan program that fits for you, the limitations on your debt ratios will change. And if you find just a debt ratio calculator online, those are usually not very accurate. Talk with a loan officer and make sure that you are going through this and getting dialed in on which loan program is going to fit and where we can make the purchase price fit within your debt ratios. A few other tips: know your budget before you get going out and looking at homes. It is painful to see people who get out, fall in love with a home, and then we have to break bad news to them that they don't qualify. You can use online calculators, but like I said, talk to our loan officer when it comes to affordability and debt ratios. There are too many variables in these for an online calculator to properly capture those. For example, there are first-time home buyer programs that really can be helpful and advantageous to you in getting better affordability. I'll give you an example. I have a client who was out shopping, told they wouldn't qualify. They came to me, found out they were a first-time home buyer. We had a special first-time home buyer program that they fit into. It really, really reduced how much they were paying in mortgage insurance because of this loan program. It got them in, got them qualified. It got them the home that they wanted, whereas somewhere else had told them that they would not qualify. Talk to the loan officer, be realistic in your your search, have a really solid realtor who can help you meet those. Please feel free to reach out to me, my team, if you have any questions on this and debt ratios and affordability. Thanks for watching. Have a great day.